Hello, everyone. Welcome back from our long summer hiatus. I hope you had a good summer and are now ready to come back and get back into our Center for Online Learning. Today's webcast is on COVID-19, investment opportunities in fixed income for public plans. My name is Hank Kim, and I'm the Executive Director of NCPERS. Today's program is part of our expanded Center for Online Learning. As we all adjust to the new COVID reality, please bear with us if there should be any technical issues or unplanned background noise during our session. As always, your patience and understanding is appreciated. We encourage audience participation. Please submit your questions by using the Zoom Q&A function. However, to ensure that we can cover all our topics today, we will hold your questions till the last part of the program. A PDF of today's presentation is also available by emailing Amanda Rock at amanda@ncpers.org. Today's webcast is sponsored by the AFL-CIO Housing Investment Trust. To introduce his firm and today's webcast, we have with us today Mr. Chang So. Chang is the CEO and co-chief portfolio manager for the Housing Investment Trust, also known as HIT or HIT. In his more than 20 years with HIT, Mr. Se has helped generate thousands of jobs and housing units while managing HIT's portfolio towards investment objectives. Chang is committed to impact investing and is known in the industry as an innovator in structured finance for housing-related investments. Chang, the session is yours.
Well, good afternoon, everyone. Hank, thank you for the kind introduction. I'm Chang So with the AFL-CIO Housing Investment Trust. I'd like to thank everyone at NCPERS for giving us the opportunity to present today. I've been with the Housing Investment Trust for over 22 years, and I'd like to take a few minutes here to give you some background on our firm. The Housing Investment Trust is a $6.8 billion fixed income fund. We operate as a mutual fund, and we've been around since 1984. But really our history dates back to 1965 when we were formerly known as the Mortgage Investment Trust. We're very unique in the sense that we're internally managed. In other words, we're essentially a cooperative. We work directly for the investors that are in the fund. Now, in 1965, the HIT, or the Mortgage Investment Trust, we were created to pull together pension capital so that it could encourage and assist in the development of lower income housing and to create employment opportunities for the construction trades. The investment idea was to prudently invest in fixed income mortgage investments that were guaranteed or insured by the federal government while generating competitive income. Again, our strategy is focused on high credit quality fixed income mortgage securities, specifically multifamily mortgage-backed securities. We believe that multifamily mortgage investments offer significant relative value versus other income investment grade products in the marketplace due to the fact that there are inefficiencies in the multifamily mortgage-backed securities market. There are inefficiencies in this space because of the scale of the marketplace. The multifamily market is much smaller than the treasury market, corporate market, or the residential MBS markets. Now, I know that this session is about fixed income opportunities in the COVID environment. think we all agree that these are unprecedented times with the highest level of uncertainty that we've ever seen. So we want to emphasize that fixed income strategies should focus on credit quality, safety, liquidity, and diversification. So I'm very confident that after hearing the presentation from the team today, you will see that multifamily securities do offer these opportunities, and objectives can be met in terms of achieving diversification, safety, while generating more yield in a highly uncertain marketplace. So with that said, I'd like to introduce Michael Cook, our Chief Portfolio Manager with the Housing Investment Trust. Michael.
Thanks, Shang. Thanks everybody for giving us the time to present here, and going to kind of walk you guys through an introductory course as it pertains to the multifamily agency MBS market and the opportunities that we see exist that certainly provide substantial amounts of value and opportunity for any investment grade portfolio. Just to start off, just going over the broad strokes of the economic impacts from the pandemic on a more macroeconomic basis that everybody's very familiar with. We've experienced devastating job losses through very high levels of unemployment due to the pandemic, due to the shutdowns, the loss of business, businesses declaring bankruptcy, industries that have certainly been permanently damaged by the pandemic, small businesses that are struggling to keep their doors open. Small businesses employ a significant portion of the American population. We experienced approximately a 31% decline in the second quarter GDP, which was the worst since the Great Depression. In addition, there's a lot of estimates out there that are stating that the previous 2 years, 2018 and 2019, in terms of level of economic activity, were lost during the second quarter. So there's a long way to go in terms of the recovery to get us back to where we were before the pandemic. We've seen massive state and local municipality budgets that have been devastated due to the loss in tax revenues. In addition, through the contraction in GDP throughout the world, you've seen global disinflationary pressures that have driven prices down on a consumer basis, that have had an effect on interest rates globally to keep them very low or even negative in some sovereign states. As a result, we have seen a substantial record response coming from our government on the fiscal side, the spending side, in addition to monetary stimulus coming from our central bank to combat the economic contraction. And it is these responses that have really shaped and influenced capital markets, as we'll touch here in later slides. Next slide, please. The pandemic, as Cheng briefly gave an overview on, obviously has had a historic significant level of uncertainty and volatility on capital markets, in addition to financial markets that have had major effects on the economy. There's been lasting structural damage that is likely to challenge the outlook in terms of economic development that poses a major long-term risk that our central bank certainly has identified, particularly in industries that have been most affected, that being retail sectors, hotel sectors, travel and leisure, and the jobs that are supported in those specific sectors that may never really fully recover. It is our belief that investors really should prepare for an extended period of extraordinarily high levels of volatility, as the future is highly uncertain. The two responses that we're going to be touching on and their influence on capital markets certainly come from, one, the fiscal side. So everybody's pretty familiar with the CARES Act in response to the pandemic, that amounted to just about $2.3 trillion of spending that supported additional levels of unemployment benefits, that gave households additional income to pay their bills and keep the lights on, support for the healthcare sector, student loan relief, state and local municipalities as they were looking to plug holes in their budgets, small business PPP loans that were done for the first time ever, that were a very big reason why a lot of these small businesses were able to keep the lights on and maybe employ a small portion of their employees. But more specifically towards the multifamily market, there was also, for federally insured loans, an eviction moratorium that came along with this. That was basically stating that as a sponsor or developer or landlord of a specific project, in order for payment relief for your mortgage, in exchange, they were not going to allow evictions of those tenants who have fallen behind in terms of their rent payments. So this certainly has supported a lot of the housing sector from creating a larger homeless effect on the larger economy. The Federal Reserve, in response as well to the fiscal side of things, has resulted in a significant cut to interest rates that we were at a 1.5% rate at the end of December and cut them all the way down to 0. Also in response was an expansion of their balance sheet that now sits at about $7 trillion. To put that in perspective, the Federal Reserve's balance sheet before the 2008 crisis stood at just about $1 trillion, which represented just south of 5% of our GDP. Now the Federal Reserve's balance sheet stands at about 35% of our US GDP, which just goes to show the significance of the issue at hand that was caused by the pandemic. The market certainly is not expecting interest rates or the Federal Reserve to move from their forward guidance. They are not expected to raise rates for the next 3 years, and the market thinks it might be another 4 years until the first increase in the Federal Reserve rate on the short end of the yield curve. So it is that expectation with lower inflation expectations and goals that have not yet been met by the Federal Reserve that we do expect interest rates, and I think the market largely, that interest rates are here to remain low for the foreseeable future. In addition, the Federal Reserve also got a new principles and a new framework to really maximize employment in this country and allow our higher levels of inflation above 2%, which would ultimately keep rates lower for longer to achieve those targeted goals. Next slide, please. There's been a significant divergence that we've experienced and seen in capital markets, as you guys can see by the charts. On the chart to the right, you can see record appreciation and valuations that have been experienced in the equity markets that it seemed to be pricing in a more V-shaped recovery in terms of economic activity, significantly diverging from what we see or experience within the 10-year Treasury yield that is still trending at or near historic all-time lows. It seems as if the safe haven Treasury market is pricing in a much slower recovery in growth and a prolonged expectation of these low interest rates coinciding with the Federal Reserve's expectation of lower for longer. Next slide, please. This is where we see a significant opportunity that presents itself with mortgage-backed securities and any investment-grade fixed income portfolio. As we stated, the expectations of a prolonged economic recovery and historically low interest rate environment and the uncertainty that in the outlook that exists ahead. Agency multifamily securities offer investors looking to offset riskier portions of their portfolio that have basically 3 major benefits in multifamily securities, agency in particular. Capital preservation through the government agency credit quality or guarantee, a yield spread relative to credit equivalent bonds, that being treasuries or credit equivalent corporate bonds. In addition, prepayment protection by way of call protection or yield maintenance that provides steady income for fixed income portfolios, unlike the residential mortgage market or residential mortgages that do not have any prepayment protection or penalty that adversely affects your cash flows in lower interest rate environments. Multifamily MBS offers government credit quality equivalent to treasuries that generates similar spreads or perhaps even higher when you look at construction agency lending or construction mortgage-backed securities than high credit quality corporate bonds. When we look at it compared to the residential MBS market, when we saw and experienced a record decline in terms of the level of interest rates in March during the depths of the crisis in capital markets, residential MBS experienced record prepayments resulting in significant contractions in index duration of nearly half, going from about 3.2 years to about 2 years at the end of September. And by comparison, when you feed that through into returns year to date through September, when you see a product like agency multifamily CMBS that has prepayment protection, they generated returns of about 8.4% year to date through September, and comparing that against the residential mortgage market that only generated about 3.62% returns, outperforming by more than double when we look at it on a relative basis by close to 475 basis points, a significant impact in returns to overall portfolios. Fundamentally, when we look at the investment in multifamily MBS, agency multifamily can nearly double the income relative to a duration equivalent treasury, as I'll show you guys in later slides, that has the same credit quality with prepayment protection, generating significant value for any institutional investment grade fixed income portfolio. And as we've touched on recently and previously, the Federal Reserve projecting to keep interest rates at 0 for the next 3 years. Agency multifamily offers investors significant yield spread in a liquid market having prepayment protection. Next slide, please. Particularly within the investment scope or universe of multifamily investments, particularly in construction-related agency-insured products. This inefficient market, as Cheng touched on earlier, offers the most attractive risk-return profiles out of any agency sector, specifically in multifamily investments. This government-guaranteed multifamily construction loan provides significant spreads at an attractive risk-return profile relative to other investment-grade sectors that offer the widest yield spreads to treasuries and agency credit investments. As you can see in the chart down to the lower right, you can see that on a duration equivalent basis, the 10-year treasury and the Ginnie Mae construction permanent loan security that exists out there has the same amount of duration of close to 9.5 years. However, the expected yield on a Ginnie Mae construction loan is 2.2% versus the 10-year treasury that at the end of September was just at around 70 basis points, representing 153 basis points of additional yield spread or income to a portfolio or investment that you get over a comparable credit quality treasury. In addition, there's other relative value aspects to investing in Ginnie Mae secured construction permanent mortgages. It's these spreads that when they convert to permanent securities, when these properties get built, leased up, stabilized, and convert, that the yield compression between the construction and the permanent provides additional price appreciation that in normal markets can generally attribute about 4 to 5 additional points of return to that investment. Next page, please. Going over the overall landscape in terms of the agency multifamily market, total multifamily origination from all capital sources generally amounts to about $360 billion, and that was at the end of 2019. Now, within that $360 billion of origination, about half of that now is within GSE-related or agency-related multifamily. So it's a significant portion of about half of what we see in terms of origination per year out of all of multifamily that consists of both construction and permanent loans. It is within this agency sector that the opportunities exist in this smaller market space that do have these inefficiencies. In particular, the agencies through the regulator FHFA have also required originations within specific multifamily properties to be 37.5% mission related or affordable to help combat, which we will talk about later, the affordable housing crisis that is currently ripping through the country that has been made worse by this pandemic. Now, that a lot of that consists of permanent loans because the GSEs do not originate construction loans. When we look at construction-related investments that are credit enhanced with FHA insurance, and they are secured by Ginnie Mae, which guarantee 100% of your principal and interest on any investment in the event of a credit loss. It is a much smaller subset of what we are seeing out there in terms of total origination or market size. FHA typically originates about $4 to $6 billion per year of loans, and this is where the most opportunity exists in terms of multifamily investments, creating attractive opportunities in terms of additional yield spread and price appreciation. Next slide, please. The typical capital sources for the multifamily market come from commercial banks, life insurance companies, and government agency credit enhanced lenders. It is expected through this pandemic that, according to the MBA, total originations for multifamily across all sources will be down close to 40% in 2020. But it is largely considered that the agency funding of multifamily investments and loans act as a counter-cyclical funding source, which we have seen and experienced as it typically ranges in terms of issuance per year, anywhere from $140 to $160 billion. It is only expected to be this year about 10 to 15% lower when you compare that against 40% across all sources, you can see why it is a countercyclical funding source. Cheng mentioned earlier that on a scale basis, relative to other portions of the investment grade universe, relative to treasuries, relative to residential MBS, we are still seeing a very small market set, which is where the inefficiencies lie, especially when you compare it against the residential industry. With over $2 trillion of gross issuance expected in 2020 and nearly $7 trillion outstanding, the agency CMBS market is generally about 1/10 of the size of the residential market, but is expected to continue to grow over the foreseeable future, as I'll touch on in later slides. Next page, please. This is just a graphical representation of the growth that we've seen and experienced within the agency multifamily CMBS market. And you can see since the Great Recession of 08-09 that there's been a consistent increase in the amount of commercial mortgage debt outstanding, specifically within the agencies Fannie Mae, Freddie Mac, and Ginnie Mae to a degree, that have made up a larger portion of the fundings over time. Next page, please. When we look at the agency CMBS market or agency multifamily market relative to an overall market-based portfolio of investment-grade securities, you can see here by the composition of the Barclays aggregate, which is the most widespread index that exists out there for investment-grade securities on a fixed income basis, that agency CMBS represents not even 1% of the total outstanding share of all investment-grade securities. It is in that 1% that consist of mainly structured securitizations that come from the agencies or Wall Street or the broker community that are transacted in secondary markets that oftentimes have much lower yield and pay higher transaction costs through a higher bid-ask spread to get exposure to that specific sector. Next page. And this is where we see, despite a smaller market size and market share, that the multifamily investor base and issuance has grown considerably, as we've seen in previous slides. The primary investor base of multifamily investments typically comes from banks, money managers, and insurance companies. They all see the relative value in the call-protected assets, the income-generating capabilities and powers of multifamily, in addition to the high credit quality securities that combine for a very favorable regulatory capital treatment with regards to banks. That have driven significant growth in the sector for agency CMBS. In addition to factors like record prepayments that are being experienced in the residential mortgage market, where they have to take a lot of those prepayments and reinvest it in higher yielding or higher spreading assets to where multifamily provides the most significant value. Liquidity in this sector has been well supported through multiple financial cycles due to its credit rating, the size of the market, consistent new issuance in primary markets, and there's been a growing number of Wall Street dealers and now the Federal Reserve making liquidity readily available. The typical bid-ask spread or the transaction cost in normal markets for agency CMBS or agency multifamily can range anywhere from 1 to 5 basis points in normal markets, but they can trend all the way up, as we've seen in recent spikes in volatility, that bid-ask spreads can get as wide as 10 to 15 basis points. But there's always a market bid for liquidity available. And currently, I would say the bid-ask spread in the market ranges anywhere from 2 to 5 basis points now. So we're well within the range of normal. When you compare the bid-ask spread in terms of the more riskier private loan sectors, the more riskier parts of the CMBS market, those bid-ask spreads can get as wide as 100, 200, even no bid in the marketplace. So there's always substantial liquidity available due to the relevant factors in multifamily MBS investments, which is why there's a tighter bid-ask spread for this most liquid market. Next page, please. Directly sourcing MBS or multifamily MBS investments provides the most alpha or the most excess return or the most opportunity in terms of relative value. The most common way to invest in multifamily is through broker-dealer syndications and structured agency multifamily products, but you give up yield and spread and pay transaction costs to do so through the bid-ask. The HIT has been able to add substantial amounts of value by directly sourcing these multifamily investments from a variety of originators. Investors with significant extensive knowledge, resources, experience, relationships, An investor's capacity to source these directly generates substantial value, having deep understandings of the real estate market by developing relationships with lenders, state housing authorities, agencies, and able to execute these very complex transactions in various structures. My colleague Ted Chandler will be touching on a couple factors and projects a little later in the presentation that are going to give you an inside look in just how complex these transactions can become. Providing capital as an investor in Ginnie Mae FHA-insured construction permanent loans directly with the originators or lenders or sellers out of competition with the rest of the market also provides significant amounts of value and yield opportunities that exist when you're not in competition with the rest of the market or industry. Sourcing DUS bonds directly, Fannie Mae DUS bonds, can also pick up additional yield relative to structured securitizations, as I mentioned earlier, that make up the biggest portion of the small segment of the allocation within the agency CMBS market in the Barclays aggregate. These benefits come from the government subsidies and guarantees providing significant amounts of capital preservation during times of uncertainty, yield spread, and certainty of cash flow through prepayment protection within multifamily MBS. Next slide, please. Conservative underwriting, if we look at the fundamental performance of agency multifamily loans or the properties themselves during different real estate cycles, they are very well performing, as you can see from the charts below. During the not the most recent, but during the housing crisis of 2008, 2009, you can see in the bottom left chart that the GSE loans that were significantly delinquent didn't even reach 1% of the total debt outstanding during the depths of that housing crisis. You can look at the private markets in CMBS, where you can see a lot of those delinquency rates that reached close to 10%. So there's significant outperformance on a property fundamental basis within agency CMBS or agency loans that is generally experienced. On affordable properties in particular, we are seeing or experience much lower levels of default than market rate properties. And properties or characteristics such as credit risk share between the lender and the agencies, but a lot of skin in the game, making sure that these loans perform over time and do not brush up against any significant loss due to non-performance. When we look at Fannie and Freddie's delinquency rate today, they are only stand at about 0.1% or 10 basis points of the unpaid principal balance that exists out there. When we look at forbearance, which is a policy that is basically providing a sponsor or landlord the ability to defer paying their mortgage in exchange for keeping residents in their units, that prolongs their projected repayment period. They only stand at about 1.1% for Fannie Mae and 2.4% for Freddie Mac, which mostly consists of student and senior housing loans and small loans, small multifamily loans out there, more mom and pop landlords that exist. So I would say the performance on a fundamental basis has been extremely surprising and very well supported through this pandemic. In addition, for those investors who are worried about the credit risk of a specific project or default risk with any specific multifamily investment, it's important to reiterate and point out that due to these guarantees that come from the GSEs or a government entity, that 100% of your principal and 100% of your interest is guaranteed. So even if the property misses a payment, as an investment on your capital, you will never miss a payment in terms of your projected interest over the life of the loan. Next page, please. In terms of the opportunity set that exists out there within multifamily, there is a significant housing crisis that exists. Multifamily housing demand has been dwarfing supply for the past 10 to 20, 30 years. Significant shifts in the demographic trends and growing population support the future need for more rental housing. The cost of housing or a home has become increasingly expensive. So lower cost options certainly are in much dire need, especially in the affordable area. As of June 2020, in terms of housing formation, we're looking at about 3 to 4 million additional annual new homes that are needed in order to house families that are currently going or moving on to start their lives. So there's a significant need for more housing stock and rental stock that exists out there within the multifamily landscape. More concerning is probably the affordable housing crisis that is ripping across this country and been made worse by this pandemic. Two studies that I'd like to look at and reference here to point out the significant divergence between demand and supply is one. Freddie Mac came out this year and said that through their findings, 10% of rental units are affordable out of all the affordable or all the housing stock on the rental side. To households that are earning half, 50% of the area median income. So there's significant demand that exists out there for affordable units. Now on the supply side, according to the National Low Income Housing Coalition study that took place this year, they are finding that there's a shortage of 7 million rental units that exist out there. Only 36 affordable homes exist for every 100 low income households that are looking for affordable housing. So it is our expectation that the opportunity set that exists out there for multifamily, specifically affordable housing, is infinitely attractive. And with this, I'd like to give the rest of the presentation or touch on the remaining slides to my colleague, Ted Chandler, who's going to go over some of the more typical term sheets and structurings and give you guys more of an inside look and just how these multifamily investments get put together from an investment side.
Thanks, Mike, and thanks to all of you for joining us today. We wanted to share a typical term sheet for a government-backed construction of perm loan with you so you can see what a developer sees and what appeals to them and what appeals to us. The reasons that this kind of loan appeals to an affordable housing developer is that it's non-recourse debt at government-backed rates. They are very long-term loans with a 40-year term and a 40-year amortization. When you combine that with high loan-to-value ratios, that means much greater loan proceeds than from a bank or private lender. And these loans are fixed rate with a one-time close. The construction loan and the permanent loan close together. And those features just aren't available from banks and other capital market sources. And by the same token, the reason those terms appeal to us as an investor in these securities is they are government backed, so they have a similar creditworthiness to treasuries, but in a spread product, the higher income that comes with that. They have prepaid protection. Unlike single family mortgages, these mortgages aren't prepayable at will. So that's a significant level of investor protection from the refinancing or prepayment risk that's otherwise associated with mortgage-backed securities. And the complexity of this structuring gives us a lot of levers that allow us to customize the acquisition of these securities and the execution. For example, we can customize the prepay period from the standard 10 years. In affordable housing developments, the income restrictions have to last for at least 15 years. So developers often want longer protection from their own refinancing risk and from variable interest rates. Another lever we have is we can split the rate between the construction and the permanent financing. Basically, the cost of a buy down of the permanent loan interest rate qualifies for additional tax credit subsidies, and that enables us to charge a higher construction loan rate or otherwise segment the construction loan from the permanent loan. The next slide, please. I also wanted to focus today on an example of how being a long-term partner very close to the financing of a complex transaction can pay very big dividends for an investor. We've been part of the redevelopment of the Old Colony public housing development in South Boston since 2010. It involves the rebuilding of 845 units of public housing, which we've been financing through the state's Housing Finance Agency, Massachusetts Housing Finance Agency. So far, we've financed 550 units in 6 phases, including 2 more buildings encompassing 170 units that we financed this summer, totaling $79 million of investment in these latest 2 phases. There's 2 levels of protection for an investor in investing in this debt. First, the underlying rents are guaranteed by a long-term contract with the federal government. And second, the securities themselves are backed by either federal insurance or by the housing agency's credit, which is separate from the state's credit. And the agency, for example, has multifamily bonds that are total more than $2 billion in principal balance. So there's a significant cash flow that comes from the bonds that back the multifamily bonds that they issue. We invested in Old Colony not only in long-term debt, but also short-term financing, 5 separate credit-enhanced financings in 7 different instruments. The key thing to focus on here is in the chart on the bottom half, the spreads to treasuries, the incremental income to treasuries that are in the last column to the right. So in this $79 million investment, we earned a weighted average of 178 basis points per year higher interest rate than treasuries in this credit enhanced product. Next slide, please. Now in this table of the investments, as well as the picture on the right, you can see the complexity that these 7 different instruments presented. By customizing the forms of the investment, by taking advantage of the different levers that are available to us as an investor, we were able to invest in a lot of different ways. We are the investor in long-term debt and short-term debt, in construction debt and permanent debt, in taxable debt and tax-exempt debt, debt for 4% tax credit financings, and debt for 9% tax credit financing. Those are 2 different affordable housing finance tools, 2 different low-income housing tax credits that are available. The public markets don't follow the nuances of these complex financings, but when you have the skill set, you can take advantage of the inefficiencies where market prices don't fully reflect all the information that might be available if you understand the underlying mechanics of how the developments are financed and constructed. The specialized investor gets rewarded for that expertise with great relative value. A crucial part of the flexibility of the investor is not only the different kinds of investments, but also the process improvements that we've been able to make that reduce transaction costs for the issuer. We're able to negotiate private placements and separate bond series, which save money while all still being credit enhanced and all rated as a way to preserve the liquidity of the securities for us as the investor. So these process improvements save not only money, but by being privately negotiated, they also enable us to customize the financings, which enables us to win these 7 financings without having to bid in the marketplace against multiple other investors. So I'll pause there and say thank you. Go to the next slide. So Chang, closing.
Well, great. Thank you, Ted. Thank you, Mike. I hope all of you found this presentation informative. I hope you all learned something about multifamily mortgage-backed securities that are insured or credit enhanced by government agencies. You know, just recapping the key themes in terms of how we tie in the opportunities in this COVID environment to what we do in multifamily securities. As we all know, we're living in unprecedented times, the most highly uncertain economic times in my professional experience by far. But certainly there are opportunities. I think that if you pay attention to, I've been following the news during the presentation a little bit, and the Federal Reserve Chair Jerome Powell just urged the government to provide additional fiscal support and stimulus. He said there's very little risk of overdoing fiscal stimulus. So as an investor, as pension funds navigating through this unprecedented, risky market environment, it makes sense to take some of your fixed income portfolio and emphasize credit quality, emphasizing safety and liquidity. And certainly reflecting on this low rate, low inflation period that we all expect for some time, it makes sense to try to find yield spread in an inefficient space without compromising credit quality and liquidity. So we certainly think that multifamily mortgage-backed securities offer that opportunity to investors, but it does take skill, it takes experience. Certainly you saw that from Mike and Ted's presentation, but we believe that there is tremendous opportunity within the investment grade universe if you look at multifamily mortgage-backed securities and you're willing to commit the time and the effort to take advantage of these opportunities. So with that, I'd like to thank everyone again for giving us the opportunity today, and I'll pause here for any questions.
Great. Thank you, Chang. Thank you, Mike. Thank you, Ted. At this point, we'll reiterate our invitation for questions from the audience. In the meantime, let me ask you three gentlemen, what are your expectations regarding timing and impact of exit of Fannie and Freddie Mac from conservatorship?
Mike, why don't you take that one?
Yeah, sure, Hank. So Fannie and Freddie went into conservatorship back in 2008. So they've been in this limbo for about 12 years. It is the intention of the director, Mark Calabria, who heads up the FHFA, to take the agencies out of conservatorship by the end of 2024. That's going to result in a very large recapitalization for the two agencies. That's going to be very complex and complicated. It's going to require, to a larger degree, maybe lower or greater overarching housing reform to take place as well. But I think from an overall timing perspective, I think it's going to be a lot longer and a lot more complicated than a lot of people, specifically the director, actually expects.
I'd like to add something to that, Hank. Reflecting on where we are today in terms of the COVID environment, we're already trillions into fiscal stimulus and relief packages coming from Congress. We have a presidential election coming up here in a few weeks. Certainly there's going to be structural damage, permanent damage coming out of the pandemic. So I would find it highly unlikely that this would be high on anyone's list, no matter the outcome of the elections. Again, there's been discussions for over a dozen years in terms of where to put Fannie and Freddie, and I think everyone, when it comes down to details, everyone steps back and says, you know what, this is an important part of the American economy. And again, if you think about further stimulus in 2021, 2022, as we try to grow out of the damage and pain from this current pandemic-related recession, as the presentation highlighted, there is so much opportunity and demand in rental housing, in terms of job creation, in terms of social equality, economic justice, etc. I really think that it's very unlikely there's going to be significant adverse changes to Fannie and Freddie's positions in the marketplace right now.
Thank you, Ted. Thank you, Mike. Actually, jumping off that last point, somewhat about politics and about the elections, have either campaign, Biden or Trump, have issued positions relative to this area? Or can we do anything about what the potential first administration of Biden's or second administration of Trump might do?
We're going to be careful here in this politically sensitive environment here. Let's just say that I think the past several administrations here have had a view on the GSEs. Again, I think the current view as of 3 years ago in terms of what they wanted to do, in terms of taking the government influence back a little bit from the housing market, I think that was the goal that was laid out. But again, we're at the end of this first term here, and I'm not sure if they're really any closer to being able to achieve any significant changes in terms of where Fannie and Freddie go. So I'll just leave it at that.
Okay, fair enough. How about this question? Will the debt volume harm USG credit quality?
Mike, you want to take on that one?
Sure. Again, U.S. government, our sovereign debt is the biggest, most liquid capital market on the planet for fixed income opportunities or the debt side. We've certainly been down this road before in terms of risk to a downgrade, considering our overall debt load relative to the size of our GDP. But ultimately, I think even with the risk of an additional downgrade with all this additional borrowing going on, I think it's highly unlikely that we're going to see major selling in treasury-related debt and higher yields as a result to any threat of an additional downgrade, just due to the sheer size, liquidity, and access to our capital markets here in the United States.
I think, again, if I can just add something to that, I think we all have to look at our relative options and alternatives. And again, if you look at the yields in Europe, they're negative. And when you look at the pandemic and the impact to the global economy, it is not just a US problem. So every economy feeds off each other. Certainly, the global economy feeds off the US. So I would say from what we know now, there's plenty of room for us to provide stimulus into our economy and the global economy to make progress towards recovery. However, again, we are in unprecedented times. There are geopolitics and events that could come out of the geopolitical activities and events that are approaching very soon here. So again, we are in a highly uncertain market, and we are urging investors, especially long-term investors, to emphasize transparency, safety, and liquidity. And right now, U.S. Treasuries are the most liquid securities out there, certainly the safest securities out there. And if you can leverage the credit of the U.S. government into higher yielding securities through some type of specialization, for example, a specialization in multifamily mortgage-backed securities, we think that makes a lot of sense.
And yeah, let me jump on that point too, Chang, which is, as we all know, this pandemic has not affected different populations equally. Certainly, the less affluent and minority populations here in the U.S. have been greatly have been impacted by COVID more than the general population. So if the pandemic persists, what impact will it have on the performance of affordable housing projects?
I'm going to ask Ted Chandler to take on that.
Okay, thanks, Chang. Hank, there are some particular characteristics of the income-restricted developments that are pertinent to that question. Many of the projects are supported by government contracts that pay the rent or the difference between a portion of the tenant income and the total rent. The tenant's obligation is only for a portion of their own income. Second, the below market rents that are charged in these developments create a big incentive for tenants to hold on to their units. And third, many of the landlords who specialize in this space have resident services staff who assist tenants in accessing support and benefits that are necessary to pay rent, as well as prioritize rent payments. So there's a number of levels of insulation that the affordable market has, as distinct from the Class A market rental world.
And certainly the demand for rent-restricted housing units would go way up, right? If the pandemic persists, that means longer periods of higher unemployment. So again, these units are income restricted. So you would have more of the population qualifying into these units because obviously we would have more people making less money. So again, no matter how you want to slice it, Hank, I believe that the outlook for affordable housing demand is stronger than it's ever been. And we've already been in a 50 or 60 year housing shortage in terms of affordable and worker housing. So as we deal with the challenges coming from the pandemic, you can be certain that at the federal level and then at the local level that there's going to be an interest, a desire to provide more housing for the people that are on the lower end of the income spectrum.
Great.
That only makes the property's fundamentals, strengthen.
Great, thank you for that. The final question, who are some of the larger investors in this space in addition to HIT? Are you aware of any public plans, either directly or indirectly investing in this area? And if not, how do we get some of our members and public plans more involved in this area?
Sure. The agency market, multifamily market, from origination, when a mortgage is actually originated, Wall Street, they dominate the market in terms of investing and purchasing newly originated investments. And what they do is they almost always securitize them. They pull these securities into securitization structures, and they will carve out portions of the cash flows for different types of investors. Institutional investors like banks, they prefer certain cash flows, usually on the front end. They will carve out the longer cash flows to life companies and pension funds from time to time. And again, in the middle, usually are money managers that are looking for relative value opportunities for their portfolio. In terms of the pension plans that actually directly invest in the multifamily market, yes, for a long time, there's been a few of the larger plans that have invested in this space. However, as you learned today, that to maximize the value of investing in the multifamily space, you really would benefit by having the expertise and the network to source the newly originated securities directly. Even the pension funds are often getting them through Wall Street. So there's a transaction cost there that Wall Street gets to keep. And they're generally invested in your vanilla permanent mortgages or refinancing mortgages, and rarely get into the new construction space. There are some that I know are in the space, but it generally is not a focus of their activity. And what we think makes the most sense is that investors in multifamily securities should have scale so that they could pull together many of these securities into a portfolio so that they could have diversification. So even though there's credit protection, prepayment protection, and stable cash flows, we're talking about large commercial loans. Some of these multifamily securities could be several $100 million each. So many pension funds kind of shy away from making single loan investments in one loan, and they don't necessarily have the scale to have a whole portfolio dedicated to this strategy. So there are a few. I'd like to just close out that response by saying that the Housing Investment Trust has over 350 different pension funds, institutional funds or investors in our mutual fund, and I would say over 200 pension funds. So many pension funds have come to us to use this strategy and to not only seek the relative value opportunities that we discussed in the presentation, but many pension funds, including public pension funds, also care about the socially responsible investing that we can provide. So we can do targeted investing in certain localities, whether it's city or state, And we know that almost every state and every city needs more affordable housing. And again, as we saw the growth of the ESG movement the past couple of decades, there are many pension funds that are out there that have objectives to create more affordable housing and to create employment opportunities in their states and cities.
Great, thank you. Chang, Mike, Ted, thank you so much for joining us today and for your wonderful presentation. To our attendees, thank you so much for joining us today. Join us next Tuesday for an overview and discussion on retirement medical trust, how employers and employees can use pre-tax dollars to create a lifetime medical reimbursement plan. Thank you, everyone. Have a good day.
Thank you. Our pleasure.